Hello friends, in this module we will look at American call option, the payoffs. How does it work and how do the payoffs look like? Let us take an example to understand what does the payoff of an American call option look like. So primarily we are looking at how the call option works, how the payoffs will look like, and we are assuming that the call options are American style. Now this is a simple graph, price on one axis and time on other. This is how the graph looks like. Now, this is company X and this is how the graph looks like today. This is the price, which is 50 rupees. So now there is a stock, company X. It is trading at 50 rupees today in the cash market. Current price 50. Strike price of the call option, which we are trying to understand, is 60 rupees. So we have looked at this, what the strike price means. So once again, it is the price at which you are trying to buy this stock because it is a call option. So currently it is trading at 50 rupees in the cash market, but the call option strike price you are looking at is 60 rupees and the premium is $5, which means that you have to pay 5 rupees to buy this call option, and the expiry is 1 month from now. We're looking at American to make it simple. Now this is how the cash price movement has worked out, and the genius that you are perfect in timing the share pricing. So you saw how the stock prices will move, you realized that there is a great jump and you caught it at the right time. When it was at the peak, you said, let me sell it off. So what does this mean? Let us first look at the cash market and then we will compare it with the payoffs under the call options to understand how it works and how is it different. Now in the cash market, let's say if you have bought this stock at 50 rupees and you are selling it off at 80 rupees. It means that you have invested 50 rupees and you have made a profit of 80 minus 50, that is 30 rupees. So you made an investment of 50 and you have made a profit of 30. How does it look? Profit scenario. This is what we just saw. The end price is 80 rupees, that is scenario 1. And if you bought the stock in cash market, you made a profit of 30. But let's say if you have bought the call option, strike price is 60. So what happens in that scenario? Would you exercise your call option? Yes, you would. So you would buy it at 60 rupees when the prevailing price of that stock in the cash market is 80. So you make a profit of 20 rupees per share. But your initial investment, the premium that you have paid is 5 rupees. So you made a profit of 15 rupees if you bought the call. And if you bought the stock in cash price, cash market, you made a profit of 30 rupees. But let's say if the stock moved in a different way and 1 month from now, this is what it is trading at, 20 rupees. What happens? Let us have a look at it. You bought at 50 rupees and now the cash price is 20 rupees. So you made a loss of 30 rupees. But if you bought the option, will you exercise it? Will you buy it at 60 rupees when it is available at 20 rupees in the cash market? No, no one would do that. So in that case, what is your loss? You let the option expire, but your loss is the premium that you have paid to buy that call option, that is 5 rupees, your initial investment. So if in the cash market you have bought the stock at 50 rupees and now the prevailing rate is 20, you have made a floating loss of 30 rupees per share. But in the options, your maximum loss is up to the tune of the premium that you have paid, which is 5 rupees. See, this is exactly what it means. You should not always look at only the amounts of profit or the loss. You should also look at what it actually means in terms of return on investment. See, in the first scenario, when the prices have gone up to the tune of 80 rupees, you are saying that, just by looking at the numbers, you feel that you made a profit of 30 rupees. So let us always stick to cash markets. Options are no good because it's made you a profit of only 15 rupees, which is half of that. But you should also look at the investment that you have made. In the cash market, you had to buy the entire stock for 50 rupees. Your initial investment was 50 rupees and you have made a profit of 30 rupees on 50 rupees. But if you look at your options, the scenario under options, you have invested only 5 rupees, that is the premium, but the profit that you have made is 15 rupees. So let us look at percentage term. What does it actually mean? First scenario, 80 rupees, you made a profit of 30 rupees, that means it is a profit of 60%. But in the call option, while your investment is only 5 rupees and you are making a profit of 15, it means that you have made a profit of 300%. That is how the option works. That is the power of financial derivatives, options. But mind you, it also works on the other side, depending on if you are buyer or the seller of the option and what the position has moved to. Now, looking at the second scenario, when the price has gone down to 20 rupees, how does it work under that scenario? So you bought it at 50 rupees and now the price has come down to 20, which means that you have made a loss of 30 rupees at the investment of 50. That means you made a loss of 60%. And in the case of options, you made an investment of 5 rupees and the entire 5 rupees is gone, which means that it is 100% loss. So you need not always look at blindly in terms of percentages or in terms of value. You need to make a combination of all. If I tell you you will lose 100% of your investments, you will get scared. But if I tell you your investment is only 5 rupees and the upside is 300%, and that makes a lot of sense. So you need to look at the percentage and you also need to look at the entire value of your investment and how can it move, in what direction can it move. Depending on that, you need to make a call. This is how the typical payoff looks like when you compare the stock market movements in the cash as well as in the call option. Thank you so much.